Hello everyone,
Good afternoon.
welcome to Finance with Justus. I am Justus. Jerome Powell said in the last Fed meeting that the terminal rate will be higher than expected before. When is he gonna stop hiking rates? I think he will only stop hiking rates under 3 conditions. One of them, something breaks. 2, the US debt gets too big. Or 3, that he's getting fired. Democrats and even the president, they're saying that inflation is not that much of an issue. Elizabeth Warren, for example, wrote a letter to Jerome Powell and told him to stop hiking rates because he's hurting the American families. And President Biden, for example, is tweeting 1/3 of core inflation last year was due to high prices for automobiles, and that is already fixed. So he's basically saying inflation is already coming down. And it's obvious why they don't want him to hike rates even further, because every rate hike hurts the economy. And they of course want to be re-elected, just like Trump. Back in 2018, when rates were hiked before Corona, Trump said Powell is hiking interest rates too fast. I'm gonna discuss that at the end. First reason why interest rates would stop being hiked is something breaks. The labor market, housing, or consumer spending. If one of those 3 breaks, then the Fed has to stop hiking interest rates. And if they don't, until that point, we're going into a deep depression. Jerome Powell said that all of these 3 things are still too strong in his opinion. For example, to the labor market, he said, although job vacancies have moved below their highs and the pace of job gains slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. So with historic low unemployment rates, he's basically saying, the labor market is too strong, we're gonna continue hiking. And there, I kinda agree with him, the labor market is really strong right now. You can see that the job gains has significantly slowed, but it is still very high, there's still too many vacancies currently, so I wouldn't count on the job market currently breaking. Second thing, of course, was housing. The housing market, obviously, we have already seen massive drops in new mortgages. And with a massive drop in new mortgages, obviously this means less buyers. The supply has outstripped demand in many areas, but for some reason, prices have not fallen yet. While mortgage rates have maybe doubled, the home prices have fallen by maybe 20% in some areas, if even. In some places they have barely budged. If their mortgage is now $4,000 instead of $2,000, a lot of families are going to be priced out. So the housing market is already very weak. But for him, that's still too strong. Said the housing market was very overheated for a couple of years after the pandemic, as demand increased and rates were low. So the housing market needs to go back into a balance between supply and demand. Then I think, how are people going to be able to afford mortgages? Because if he's gonna raise rates even further, let's say 5% is gonna be the terminal rate. Mortgages are currently 7%. So what if they go to 9? Or maybe even 10? The average price of a house is currently $428,000. Let's say with a huge upfront, they have to take on a $300,000 mortgage. If mortgage rates go up to 10%, that means $30,000 in interest per year. Only in interest. I don't know when he will see the housing market in a balance between supply and demand. The third thing that he mentioned was consumer spending. With inflation, a lot of families are currently struggling to pay the bills. You can see that by the increase in credit card debt. It has hit an all-time high, and the savings rate are at an all-time low. But here Jerome Powell still says that households are having very strong balance sheets. But when you look at households, their investments in property and the stock market have declined significantly, and their expenses have gone up a lot. Wages have increased 4.4% on a 12-month basis. Inflation is around 9% at the same time. And at the same time, the Fed is basically saying it's still too strong. So maybe in the next 6 months, we will see consumer spending plunge a lot because real income is down, balance sheets are down. But with the Fed still seeing this part of the economy strong, I'm not entirely sure that they're gonna stop until something breaks. So the only way that things would break is a recession, in my opinion. Jerome Powell even said the probability of a soft landing has narrowed. So he doesn't believe in a soft landing as much as maybe like 6 months ago. So in my opinion, Jerome Powell will cause a recession. It's also the prominent idea that he will have to crash the economy to bring down inflation if they're targeting 2%. I believe the Fed will be more lenient if it goes to 3% or tiny bit higher. Maybe up to 3.5. I think that is acceptable for the Fed at that point. The most important thing is trust. If a market trusts them that they will bring down inflation to 2% and they're gonna do everything they can to bring it down to 2%, it's gonna make the job of the Fed a lot easier. But if they're saying, hey, actually we can't reach 2%, we will aim for 3%, that might make it even harder to reach 3% than before. So of course they're gonna use a lot of strong language until then and saying we will do everything we can. The next thing is US debt. Interest payment on US national debt is expected to exceed military spending, with debt at an all-time high and 10-year treasury yields currently yielding 4%. And if you think about it, a lot of this debt is gonna have to be refinanced soon. It's rolling over. The bond markets are expecting inflation to come down fairly quickly. If they don't believe it anymore, then maybe 10-year treasury yields are gonna jump to 6%. And imagine how much that would cost. If they would have to pay a 6% interest rate on the entire 30 trillion of national debt, that would be 1.8 trillion per year just in interest payments. That would be the highest expense of a government. Medicare and Medicaid is currently at 1.5. So if that goes to a point where the US would be close to defaulting, or print money again, which would in turn fuel inflation again, then the Fed would have to lower interest rates. With Jerome Powell saying that inflation is still too persistent, what would be the last choice maybe? Him being fired. If enough Democrats are against him, or maybe also Republicans, could he be fired and could the Fed be forced to bring down interest rates? Fire the Fed president, there usually needs to be cause. There has not been any legal precedent of a Fed president being fired. So this would be a court issue that would drag out for probably months or years. So even if Biden would fire Jerome Powell, maybe that would temporarily stop interest rates rising, but that would bring down trust in the US dollar as the reserve currency of the world. One of the big reasons why it is the reserve currency is because the Fed is independent from the government. And if that trust is destroyed, oh boy, the US dollar is going down. So I also don't think that is in the best interest of anyone involved. So with us looking at all of these things, what is the most likely thing currently? A recession. A recession will lower inflation. He says price stability is one of the most important things he's aiming at. So I do not believe a soft landing will happen. There's just way too many things playing against it. I believe a recession will bring inflation under control, or the Fed will be happy with it being at 3 or 3.5%. Do you think Powell will be happy with 3.5 or 3% inflation? Or do you even believe he will manage the soft landing somehow? Write it in the comments. Have a good day.
Thanks very much.